to me, what I'm looking for is what am I getting in return? Is the benefit worth the cost? Hi there. I'm John Stevenson, the Guaranteed Retirement Guy, and today I want to talk to you about the difference between an income rider and not paying for an income rider. So people reach out to me and they want high income levels, but when they look at the fees, a lot of times when they see these income riders, they're like, hey, John, you've got this rider charge. What's this for? Okay, why should I pay for this versus just getting a fixed index annuity that gives me market protection, gives me growth, and no fees, right? Well, I don't think there's anything wrong with either of those options. It really just depends on you and what you're looking for, okay? If you want a ton of income and you want to maximize the amount of income that you get from your annuity, then I would highly recommend an income rider. Yeah, they charge. I mean, between 1 and 1.5% is typical what we see. And that could be substantial. Over maybe 20, 30 years, you might be paying out 70 grand in fees. And so you might look at that and say, well, I'm paying a lot of fees here. Why should I pay these fees? What am I getting in return? I'm used to paying my financial advisor over here his fees, and maybe he's worth it, maybe he isn't. Why am I paying fees for an income rider? Well, that's what you're paying for, is an income rider. So if you didn't have the income rider attached, you would have absolutely no fees, okay? If you have a year where the market goes up, let's say it's tied to the S&P index and it goes up 10% and your participation rate is 100%, then you're gonna get a full 10% growth. Great, okay? The next year, let's say the market drops 20%. Well, you're not gonna lose anything, and you certainly aren't paying any fees because you don't have the income rider attached, right? So if that's the case, then your account balance will stay where it is. Maybe it's worth $500,000 and it earned 10% the year before, so now it's $550, but the market's down. And so since the market's down, of course, you're not participating in that loss. And so your account balance stays at $550. Well, that's not bad, right? But contrast that to an income rider that's paying, let's say, 9% guaranteed every year for, 10 years, okay? So they're charging you for it. Maybe they're charging you, 1.3%. That could be a substantial amount every year, right? But let's say during that same 5-year period, you have a fixed index annuity with no income rider over here, and it's earning 10% for 3 of those years. And then the other 2 years, it earns 0, okay, because the market's down. Now you look at the same $500,000 over here with an income rider that they are charging you for, but they're giving you a guaranteed 9% compounded rate every single year. Your $500,000 is a much, much higher amount at the end of those 5 years versus the fixed index annuity with no income rider. And at the end of the 5 years, if you want to take income from that annuity with no rider, then you can. But the problem is it's going to be based off of whatever that account balance is, the raw account balance, versus over here, you have an income rider that you've been charged for, but the benefit is you're getting like 9% guaranteed every single year. And not all of these are the same, right? Some of them will give you a 7% roll-up rate or an 8% roll-up rate or even a 10%. And a lot of times their withdrawal rates, which are multiplied by your benefit, those can change. And so it really depends on what the withdrawal rates are and what your roll-up rate is. So if you're being charged money every single year, a fee for an income rider, and that income rider is giving you, between a 7 and a 10% growth guaranteed for income purposes, that's pretty substantial. So it's so substantial that if you look at the income amount that you will get from something that maybe you were charged $70,000 over your lifetime in fees, the income is so much higher and makes it absolutely worth it. So what I mean by this is maybe an annuity that has no income rider whatsoever, you're not being charged for it, there's no fees coming out, but the income is a lot less. Maybe the $500,000, has grown to $600,000, right? And you turn on income. And maybe the income is $40,000 a year, joint income for you and your spouse for the rest of your life. Well, that's pretty good, right? Now that's with no fee. But let's say the one with the fee, it grew the income benefit value much, much higher than $600,000. Maybe it grew the benefit value to like $1 million or more. And what if the income is, let's say, $65,000 a year for the same premium? That's a big difference. And if you look at that for your retirement, you take that out take that out over 30 years, that's an additional $25,000 a year. You got $40,000 coming out of the annuity with no income rider, and you've got $65,000 coming out of the annuity with the income rider that you're being charged for. But the difference is, yeah, you're paying fees, $70,000, $80,000 over your lifetime in fees, right? But $25,000 per year times 10 years, that's $250,000. Times that by 30 years, that's $750,000, from 70 or $80,000 in fees. What if the fees were $150,000? Would that be worth it? To me, what I'm looking for is, what am I getting in return? Is the benefit worth the cost? And if I don't care about leaving behind the account balance to my beneficiaries, because if you are concerned about that, then choose an annuity with no income rider, no charges, and much, much less income. That way, the account balance lasts longer. You still have guaranteed income, but you leave more money to your beneficiaries. But most people who call me, they're not looking to do that. They want to maximize the income. They want to maximize the ROI from their annuity. And so they choose to pay the fee. And so whether or not you choose to pay the fee is absolutely up to you. But it is something we can go over in a call. So what I would recommend that you do is book a call with me. You notice there is a link below this video, and it goes directly to my calendar, and we'll get on the call. I'll answer your questions, and we'll see if an annuity makes sense for you. And we'll see if an income rider, or maybe no income rider, makes sense for you. So anyways, I appreciate you watching, and we'll see you next time. Hey, I really appreciate you watching the video today. If any of it makes sense to you, or if you found value, or if you even got a question about anything, I hope that you'll go to the comments section and ask it. There's no stupid question, and I'm looking forward to hearing from you.